Welcome to Objective 5 in Unit 1 of Accounting 3310. In this unit, we'll discuss the next part of the accounting information system, which is the ledger. Our objective is that at the end of this objective, you'll be able to summarize transaction information from journal entries into a ledger format. We'll be using the T-account format. Ledgers are an intermediate step in the accounting information system that's especially helpful for analysis because it gathers information from many journal entries together on an account-by-account basis. It's a summary information, and it also provides a step that's very auditable so that we can go back from a ledger to look at the underlying journal entries, and we can go forward from the ledger to the financial statement that the account is on. This is what a simple T-account form of a ledger looks like. There's going to be an account title to identify the ledger, so each account has its own individual ledger. It is divided up in the left side and the right side that exactly match the debit and credit convention that we've used in the journal entries. So all of the entries on the left in a journal entry, debits, are on the left in a ledger, and all the entries on the right in the journal entry are on the right in the ledger. So the analysis part happens at the journal entry stage. Once it's in the journal entry, we're transferring it into the ledger in the exact same position. Ledgers don't just have the individual information from journal entries, but they also provide a balance. That is, summing up all of the increases and all of the decreases to that account. Where does it stand at any particular point in time? The balances are found by adding up all of the left side amounts and adding up all of the right side amounts, and then putting the difference between the two on the side that's larger. So if there are more debits than credits, the account is said to have a debit balance. On the other hand, if there are more credits than debits, then it has a credit balance. What we see here is a debit balance account. Now, there are some accounts that systematically have a particular kind of balance, and that helps us in analyzing transactions. So assets, dividends declared, and expenses, those accounts have debit side balances, that is, left balances, so that their left side is always greater than their right side. Assets can increase and decrease, but you can't have a credit side balance that is more decreases to an asset account than it ever increased. That's just logically inconsistent. Likewise, dividends are decreases in owner's equity, and expenses are decreases in owner's equity, and all decreases to owner's equity show up on the left side. So those always have left balances. In comparison, liabilities, paid-in capital or contributed capital accounts, retained earnings, and revenue have credit side balances. Liabilities have credit side balances because you can't have more decreases to a liability than you have increases. Nobody overpays their liabilities. So we always have more increases than decreases. People pay until you're at zero, and then there's no more. With owner's equity, investors contribute funds into owner's equity, so their contributions always increase owner's equity, and they can only withdraw as much as they've put in. And so owner's equity can only decrease. Owner's equity for contributed capital can only increase down to zero. I've included retained earnings here, even though that technically can be either a debit or a credit balance. It can be, and we talked about it when we talked about the fundamental accounting equation, it can have a debit balance if a company is particularly unsuccessful. However, the normal situation is for retained earnings to have a credit balance because companies, in order to stay in business, are profitable and have revenues higher than expenses. Revenues also are always credit balance accounts because revenues are increases to owner's equity, so we only have entries on the increase side. Let's look at the features that we need to talk about for a ledger. When transactions are entered into a ledger, it's called posting, and the information is entered exactly as it appears in the journal. The transactions are going to be entered for each line in a journal entry. So if a journal entry has an increase in a building account and a decrease in cash, there'll be one posting to the cash account and one posting to the building account. Here's what it looks like. Our journal puts the information into debit and credit columns, with the rows indicating what the accounts are. The T account for cash appears here, and we see that it starts out with some beginning balance. That is, at the beginning of any period for an ongoing business, there is some amount of cash, so accounts start out with some sort of balance. Then the revenue account is posted here. It's a left-hand side entry in the journal, and it's a left-hand side entry into the T account. The next entry is a decrease to cash for rent expense. It's on the right side in the journal, it's on the right side in the ledger. The next entry is another decrease for salary. It's on the right side in the journal entry, it's on the right side in the ledger. When we find the balance, we add up all of the debit side entries, which is $300,000, all of the credit side entries, which is $11,000. The difference between the two is $289,000, and it belongs on the left side because the left side is larger than the right side. So we have an ending debit balance of $289,000 here. Ledgers don't always look like T accounts. They could look like this, in which we have explicitly shown the date of the entries. We've got an explanation column for why the change was made to the ledger, and then we've got the debit or credit entries that show the posting from the journal entry. This ledger keeps a running balance, so at any point in time I can look up and see what the balance is. That's a benefit over a T account that only has occasional balances created as needed. Here are some details to remember when you're creating ledgers for any of the problems in these chapters or in this course. Don't bother using dollar signs. We know these amounts are money amounts, so it just gets in the way and adds complications. Also, don't use negative numbers. Every number in the journal entry and in the ledger is a positive number. We're showing whether it's an increase or decrease by putting it on the left or the right. So if you find yourself wanting really hard to put a negative number on the left side, what that is telling you is you actually have a credit amount. Put a positive number on the other side. For ledgers that don't have a running balance, such as the T accounts we've made, balances can be made at any time. Simply draw a line, write the word balance, create your balance, draw a line under it, and you can add more postings in. So don't feel constrained that there's any time at which you cannot find a balance for a T account. I want to add one practical item here because this is our method here is of T accounts is to help you as a student to do your analysis primarily, but there certainly are more complexities when a company is actually recording information that they're going to use for their financial statements. That is, it's not generally enough to simply record payroll in a payroll account. We need to know who is getting which payroll check. Or accounts receivable. We don't want to know just what is owed to us in general. We want to know what each individual customer owes us. And so those individual accounts that are identified to a particular person are called subsidiary accounts. And the general account, which is what we'll be using in this class primarily, are called control accounts. We are not going to get any conceptual or insightful benefit about recording it at that extremely detailed level. So we'll always be recording in control accounts. But just remember in the back of your head that there certainly is more detailed information available at the company level for real companies. Here's a practice to make sure that you understand how to use this T account. What if we've got an accounts receivable account that had a beginning balance of $25,000 and it had two credit sales, one for $10,000 and one for $2,000, and it had one receipt from a customer of $4,000 that decreased accounts receivable, and there was one account that was identified as uncollectible, so that's a write-off of this account. Here are the postings from that description of those four events. What is the ending balance? If you need to pause here while you get out your calculator and figure this out, pause this video and then come back and check your answer with me. Here's the ending balance I have, the $32,000. Add up all of the left side amounts, that amounts to $37,000. Add up all the right side amounts, that's $5,000. The $37,000 minus $5,000 is $32,000. Put that number on the side that's larger, so it goes on the side with the $37,000. This is a debit balance of $32,000 in accounts receivable. If we look at it, this also has a great deal of face validity because this is an asset account, and an asset account is going to have a normal debit balance because debit is the side that increases assets. So we would never have a final credit balance in accounts receivable. That would mean that our customers owed us money, and it would it would no longer be an asset to us. We're going to continue from here to use these ledgers in creating a trial balance and then financial statements. I'll talk with you again when you're in your next objective. Thank you.